Hi students, thanks for clicking this video. In this video, you are going to learn about dissolution of partnership firm. We are going to deal a problem. Problem is PQR were partners in a firm sharing profits and losses in the ratio of 5:3:2. So it is their existing profit and loss sharing ratio. Partners PQR. These three are partners in a firm. They agreed to dissolve their partnership firm on 31st March 2018. So all the partners agreed to dissolve the partnership firm on the date of 31st March 2018. P was deputed to realize the assets and pay the liabilities. He has to be paid ₹1,000 as commission for his service. The financial position of the firm was balance sheet as of 31st March 2018. Liability side, creditors 10,000, bills payable 3,700, investment fluctuation reserve 4,500, and two partners capital contributions collectively 52,550. 550. Ours capital is 8,000 rupees. Stock is 5,500, investment 15,000, debtor less provisions 6,650, and cash rupees 5,600, plant and machinery 30,000. So collectively 70,750 both the side assets and liability side. Some adjustment. P took over investments for rupees 12,500 rupees. Partner P took over firm's assets for 12,500 rupees. So P is a responsible person to pay 12,500 to the firm. And stock and debtors are realized 11,500 only. At present market value for stock and debtors only 11,500. Plant and machinery were sold to Q for rupees 22,500 for cash. So plant and machinery sold to Q for rupees 22,500. And unrecorded assets realized 1,500 rupees. Realization expenses paid amounted to rupees 900 rupees. Realization expenses, and they are asking us to prepare necessary ledger accounts to close the books of the firm. To close the books of the firm, in our realization account, we are going to realize. So all the assets will be take place in the debit side of realization account, that except cash, stock, investment, and debtors less provisions, and plant and machinery. So these all are assets. It took place in the debit side of realization. Look at this: plant and machinery, stock, debtors, investments. So these all are assets which was available in our books of accounts. See, investments, stock, debtors, and plant and machinery. These four items will take place in debit side of realization account. Debit side of realization account. It is not a revaluation account, it is a realization account. The next one, these assets should be sold out, because realization account is opened for the purpose of realizing the valuation of assets and liabilities. They are going to sell all the firm's assets and they are going to pay all the liabilities of the firm. So assets should be sold off, liabilities will be paid off. Now we are going to sell these all the assets. Actually, these are the books of accounts assets. So assets value may change at present. With the help of this market value, we will come to know. Here they given some information which is related to all the assets changes. And liabilities, first one is P took over investments for rupees 12,500. Check it out. P has to pay 12,500 to firm. 12,500 rupees for investment P paid to the partnership firm. Next one is stock and debtors realized rupees 11,500. At present market value for together stock and debtor is 11,500. So we are going to write, which is stock and debtors are sold out here. Stock and debtors are sold out here for 11,500 rupees. Here all the assets are entered. Assets will be sold out. Assets will be sold out and liability will be paid out. Liability will be paid out. We will come to the next part about liabilities will be paid out. Now we are selling all the assets. First one is stock and debtors are sold out for 11,500. It is the market value. Can you understand? Next one, plant and machinery were sold to Q for rupees 22,500. Check it out. Plant and machinery 22,500 we sold out. And the next one is unrecorded assets rupees 1,500. Unrecorded assets 1,500 rupees. Here stock we have written, plant and machinery, and investment P paid 12,500 rupees, and debtors also, stock and debtors included. And next one is unrecorded assets which was given in adjustment. If they given any information which is related to assets or liabilities in the adjustments, that will not take place in the debit or credit side top, isn't it? So if it is related to asset, that will be take place, assets will be sold off that place only. And if it is related to liabilities, that will take place, liability will be paid off. Okay, liability will be paid off place. So now all the assets are sold off for rupees 35,500 rupees. And liabilities are given here clearly in the liability side of the balance sheet. Creditors, bills payable, investment fluctuation reserve. These three are liabilities. Creditors rupees 10,000, bills payable 3,700, investment fluctuation reserve is 4,500. And in the asset side, the provision for doubtful debts, so it is considering as a liability. 450 rupees is entered in the credit side of realization account. So all the liabilities, books of accounts liabilities are entered. So now all the liabilities we are going to pay. So first one is creditors rupees 10,000 rupees, because in market value they didn't give any information which is related to creditor. They given first information is P took over investment, and second one is stock and debtors, third one is plant and machinery, and fourth one is unrecorded assets. But no information which is related to liabilities, but only one information they have given, that is realization expenses is paid, amounted rupees 900. So realization expenses took place over here, it should be paid off. And bills payable rupees 3,700, and apart from that, investment fluctuation reserve will be taken part in capital account of all the partners, and provision for bad and doubtful debts will be deducted from debtors. So now we are going to pay all the liabilities collectively 14,600 rupees. So liabilities will be paid off. P's capital rupees 1,000. In the problem first line itself they have given P should be paid commission rupees 1,000. So that is the liability of the partnership firm. And we are adding all the details which is entered in the debit side of realization account. So debit side of realization account shows the balance is 73,200, and the credit side we are expecting 72,300, but already available amount is less than 73,200. Nearly 6,550 rupees is less. 6,550 rupees is less. As per their existing profit and loss sharing ratio, this realization loss will be shared to all the partners. So realization loss is 6,550 rupees. So this will take place in the debit side of partners capital account, and it is partners capital account for P, Q and R. We are referring the previous year balance sheet, books of accounts. Liability side, it shows information for partner P and Q. They contributed together 52,550 rupees for the firm, 37,550 by P, 15,000 by Q. And another one partner is R. He is maintaining debit balance of the partnership capital account previous year. So that is 8,000 rupees is a debit balance. So that is taken place in the asset side of previous year balance sheet. See, it is brought down 37,550 for partner P, 15,000 for partner Q, and 8,000 the debit side of partners capital account for partner R. And 1,000 rupees will be paid as commission for partner P, isn't it? For partner P. So that 1,000 rupees will be paid to partner P here. And realization loss, realization loss we comes to know, this is realization loss as per their previous year profit and loss sharing ratio. It will be shared to all the partners. So realizations loss are shared to all the partners as per their existing profit and loss sharing ratio. And another one is one of the partner, who is that? P. Partner P took over investment rupees 12,500. So specially this 12,500 rupees will be paid by partner P, isn't it? And next one, we are going to tally both the side. So here for partner P and Q maintaining credit balance again. So they are getting carry forward balancing figure in the debit side of partner's capital account. That amount is rupees 22,775 for partner P, 13,035 for partner Q, and for partner R it is a debit balance, because here debit side is excess than credit side of the partner's capital account, so it is debit balance for partner R 9,310 rupees. Now we are going to prepare cash account. Cash account information is already given in our balance sheet. How much amount is cash over here? Cash is 5,600 rupees. It should be brought down in the debit side of cash account. Cash account 5,600 rupees, and realization asset sold amount and liabilities, how much should be paid out. So asset actually sold for 35,500 rupees. It is realized assets. Assets are sold off for 35,500 rupees, and liabilities, total liabilities are 14,000 rupees. We are going to refer our realization account. What is the assets realized value for cash? Because assets are sold off, liabilities should be paid off. So what is the asset sold amount? Asset sold amount is rupees 35,500 rupees. It is asset sold amount, and liabilities altogether, liabilities are paid off 14,600 rupees. 14,600 rupees. So liabilities will take place in the credit side of cash account 14,600, and assets took place in the debit side of cash account, that is 35,500 rupees. We are having amount in cash, and you know that R's capital account shows debit balance, which is debit side excess than credit side, so that is 9,310 rupees, collectively 50,410 rupees. And you know, for capital account, in the capital account you got the information about capitals, credit balance for partner P and Q, that is 22,775 for partner P, 13,035 rupees for partner Q, and collectively 50,410 rupees. I hope you enjoyed, and I hope you understood this problem. This problem will come for the exam. Definitely it will be asked for 6 marks. 6 mark based question it is. You practice many problems. Don't hesitate to ask your doubts. Thank you. Thank you for watching till end.